Welcome to Tradiers, the Trader's Edge. I'm Jim Iuorio. That's Bob Iaccino. We hit on something before. Like I always say that Bobby's the Robin to my Batman, and it pisses him off. But today I called him the Kato to my Green Hornet. And actually, Kato's pretty cool. So I actually think we can live with that one, right?
Kato was much cooler than Green Hornet.
Well, then I got to find a new one.
He's much cooler. So I'm sticking with that one. It's actually the idea that I somehow am unequal but compliment you that offends me. Not the actual.
Yeah, and that's why I'm trying to offend you as much as
I do. You're trying to perpetuate.
Good. Well, happy Liberation Day to those who celebrate. We are going to be breaking it down live. I don't know what the hell Liberation Day means. I guess he's saying that he's freeing us from the shackles of unfair trade policy and he's liberating us. The man has a way with words, and it's usually designed to piss people off. No?
Yeah, I mean, I don't know where he came from that either. I mean, I think the idea of reciprocal tariffs is interesting as hell, and I kind of can't wait to see how this plays out, really. But yeah, I don't know what he'd be liberating us from. Yeah. I was just going to say the exact same thing you said, so we'll go with that.
Yeah. So you know what? Normally, Bobby and I talk about 2 minutes and stuff about nonsense, but I'm kind of excited to get the guest on today. One thing I've said before is that you guys could have been following us in media for the 25 years we've been in it. You can think that Bobby and I are full of shit, which is fair. We've given some opinions that have been bad, some that are good too. One thing you cannot deny is somewhere along the line, we have made great connections to get great guests. And this is going to be an amazing guest. I'd like to bring in Eric Basmajian, who is a business cycle analyst and I believe the president founder of EPB Research. Let's bring on Eric. Eric, do you have any idea who the Green Hornet and Kato even are? And you don't have to fib.
No, I was listening to the intro there. I was hoping you'd break it down for me.
So it was a show.
First of all, that damn intro photo that makes him think he can call me
Robin to my
higher than me in the picture. But I'm going to see him in person soon.
And we'll get this all straightened out.
See what he called me.
Yeah. But anyway, it was a cool show. I can't remember who played the Green Hornet, but Bruce Lee played Kato. That was his starring role, his first starring role. So Kato was pretty cool. So it is kind of a compliment. Where are you coming to us from? What city?
I'm just outside New York City.
Very cool. And how long you been in the business? A long time?
Yeah, about a decade now.
Oh, that's fantastic. Cool. Anyway, today's Liberation Day. Have any headlines? Bobby, you're monitoring the headlines, right?
I am. I actually, before we came on, I forgot that I needed to. He's about to talk now, and it's just a funny scene. Like he's got it's almost like a mini State of the Union. I see a bunch of guys in like union vests, like they're construction workers up there. He clearly invited. We're protecting those people.
Hey, that was not bad, Bobby. You're getting there. That was not bad. Anyway, so let's talk about tariffs real quick before we get the headlines out. You know, unsurprisingly, the left says this is ridiculous. It's going to drive us into the Great Depression. Unsurprisingly, the real supporters say this is fine. Everyone's been treating us badly. Guys like us in the center are usually saying, guys, this might go good, it might go bad. And to say that the consumer pays for the tariffs is true and false at the same time. There could be 4 possible payers of the tariff. The exporting country may subsidize. The exporter may swallow some of the margin. The company that imports may compress margins a little bit. And yes, the consumer. What am I missing, Eric? Is it terrible policy? Is it opaque?
So yeah, happy Liberation Day. And Bob, you're going to have to feed us the information as it comes in.
Add it up here.
Dealing with stale information, because this could all be a moot point in 5 minutes, or we don't know. But as far as tariffs go, we'll just talk about the economic theory of tariffs versus what's actually happening, because there's a lot going on here. And tariffs, just as a pure economic policy, generally are bad for economic growth. There's a lot of research behind this, and if you just take blanket tariffs for what it's worth, generally the final analysis will reduce economic growth. Because if you think about it, it's an unnatural policy that's trying to shift production towards a place that's likely less productive than where it was flowing based on natural market forces. So just tariffs as the standalone is generally, in the final analysis, bad for economic growth as a whole. Now, it could be protective for the industry that is, is the beneficiary of tariffs, of course. But we have to look at the second, third, and fourth order effects of what the tariffs are. And generally speaking, it would be a negative for economic growth as a whole. That being said, there are, some legitimate use cases for why tariffs would go into place. For example, national security. It's a totally legitimate use. Getting critical industries out of China, for example. I'm certainly sympathetic to that. There are also, like you mentioned, the idea of reciprocal tariffs. And of course, tariffs can be used as a negotiating tool, which I think that, even as we get here, and today we're finally at the Liberation Day, most people, I think, are still of the opinion that these are mostly being used as a negotiating tool, and this is not something that's going to be on long term. If we were to just take it at face value, slapping a 25 broad-based tariff across the board would be a negative for economic growth. But if we deal with the nuance that's likely to come with this policy, it's not likely to be as direct as that would be. So I think we'll have to wait and see what it is. What tariffs ultimately get put on the board, what countries, are there any loopholes, are there any exemptions? During Trump 1.0, there were some tariffs, obviously, but they were pretty open in terms of some exemptions and loopholes, and it didn't really have a material economic bite in terms of growth or inflation. These tariffs are threatened to be a little bit bigger and more broad-based than that. But, we've had the first round of delays. Now, he's been saying that there was an article today that Besson said that, the tariffs that are going to come out are going to be a ceiling that countries can negotiate down from there. So we still don't know if these are really being used as a genuine attempt to onshore manufacturing. If that's the case, that's going to be a pretty painful process. Are they going to be used as a negotiation tactic? Are they used for, targeted national security reasons? A lot of legitimate cases here, but I think we'll wait and see what happens in the next hour, or what the case is there.
Bob?
So right now it's just rhetoric, right? He's doing the hands, he's doing all the stuff. So nothing to report as of yet. More importantly, Van Williams played the Green Hornet. So
Van Williams. Okay,
that's in the 1961-62.
By the way, people who are watching, can I interrupt you 1 second? Does Eric not look like, and please chime in the comments, the actor from New Girl, and then he's in a show now called The Neighborhood. Eric's a lot better looking and slightly less feminine. Not that guy's feminine looking, but you're definitely more guy than he is. But I want to know if I'm crazy or not. Anyway, Bobby.
Yeah, so I want to ask some just sort of general questions, and maybe you have the answer to this, maybe you don't. I'm kind of ambushing you with these, but tariffs. So I was looking at, the first thing I did is I did some research, which is Bob speak for. I typed a bunch of stuff into 4 different AIs to see what they match up with. Not like I pulled out encyclopedias or some shit. And I asked a bunch of questions about what countries have some of the biggest unmatched tariffs on the U.S. It was things like 200% on U.S. automobiles into India, and it was like 234% on U.S. rice into Japan. There's pretty high tariffs, somewhere in the range of 75% on U.S. dairy into Canada. Another high tariff, and I don't want to quote the number because I don't remember it, on U.S. lumber going into Canada. So there were a lot of these, and most of these have been on for a decade or more. Vast majority of the ones I mentioned have been on for over 30 years. So I looked at that and I asked the question, did these tariffs cause inflation, specifically inflation in these economies? And the answer from every single AI that I tried said, no, they just bought their domestic goods, right? Now, I understand that it's different here, right? Because we're a larger economy. And quite frankly, if you use autos as an example, they're basically foreign cars assembled here for the most part, right? Parts going back and forth across the border between Mexico and Canada and then assembled here. If we have no, I'd say in the last 50 years, evidence of inflation brought on by tariffs, is this time different, which is probably what I think, or is it not actually proven that tariffs cause inflation as directly as some people will say in conversations on CNN and the like.
So tariffs don't cause inflation in the true sense of inflation. So tariffs can and likely do in many cases cause a price increase in the good being tariffed. But a tariff on cars won't increase the price of rice, for example. So when we think about the inflation that was caused during the pandemic, that was a monetary based inflation that caused the price of all goods and services to rise. The price of cars went up, the price of food went up, the price of lumber went up, the price of all items went up, and the economy was able to stomach an increase in the price of all items because there was such a rapid increase in the amount of money in circulation. So if the Fed or fiscal policy together don't jointly cause a huge increase in money supply, then tariffs can't really cause broad-based inflation, because if there's no increase in income in the economy, you can't simultaneously stomach an increase in the price of cars while also generating an increase in the price of food. So unless the tariffs are matched with a hyperinflationary monetary or fiscal policy, what tends to happen is you have a price increase in the good being tariffed, which is offset by a price decrease in another good, or you have a price increase in the good being tariffed, which is offset by lower unit volume of the good being purchased. So nominal growth essentially doesn't change. I don't think it's going to be different this time, and that was the case during the first Trump round of tariffs.
2017.
Exactly. It's completely different. The inflation that we experienced during the pandemic, which was all goods and services going up pretty rapidly. So I don't think that, if Trump applies tariffs on one good, that's going to cause the price of all items to go up, which is really inflation. But, people will say if you tariff cars and cars go up, that's inflation. I mean, it is inflation in the sense that the price of the car went up, but it's not inflation in the way that we define it really in economics.
But Eric, and even if we were just, let's say it was broad-based and it was everything was tariffed, just for this theoretical question, it's not, in order for inflation to remain persistent and consistent and move forward, there has to be an anchored inflation expectations provided with a money supply increase too. That's my opinion. I want to get your opinion of that. This, it seems like it's just like ratcheting the price up and it's a one-time thing and there's no follow through if it's a tariff caused inflation. Am I crazy?
Yeah, it wouldn't be an inflationary process as you're describing, but even still, if it was broad-based across the board and all items went up 20%, if the income level in the economy is unchanged, that would have to be offset by people purchasing less quantity of those goods. Otherwise, where is the income coming from? So it's not a general inflationary process the way it was during the pandemic, which was the true definition of too much money chasing too many goods, real legitimate inflation that sort of fed back onto price increases in other goods.
The Milton Friedman, Jimmy, the Milton Friedman definition, we're back there again. So I want to read a couple of comments from one of our regular viewers, Widge. And at the same time, I want to put up a picture of the Green Hornet and Cato, if I could. This isn't a negotiating tool in regards to that they're going away. I fully believe this will be systemic and long lasting, just negotiation around the edges. I like that comment. And then Widge put a second comment. I believe this is complimenting you, Eric, because Jimmy and I just talked like idiots. Great explanation of monetary driven price inflation versus tariff driven price inflation. I think the key to that comment is monetary driven price inflation is often sustained and accelerates. Am I wrong to think that?
Yeah, exactly. And there is a risk here, I would say, in the sense that let's say that tariffs go into effect and it does cause a negative economic consequence as a result of that. And then the Fed responds to that negative economic consequence with expansionary monetary policy. Then you could have a situation where tariffs are then met with expansionary monetary policy, but it does take multiple steps to get there. It's not necessarily that the tariffs alone caused the inflationary process, but you could have, a couple of steps or iterations that get you there. If the commenter is correct that the tariffs are going to stay on, they're going to be long lasting, and there's really not a whole lot of room to negotiate other than around the edges. In my opinion, what you would see is you would see, at least initially, a negative economic growth consequence associated with that. Generally, an increase in unemployment associated with that. It's just, at the end of the day, you can't argue with the fact that the tariff is just raising the cost of production, whether it's internally or externally. And unless the consumer or the economy has more income to deal with, it's just going to be able to produce less unit volume or purchase less unit volume, which is, part and parcel with the definition of recessionary process. So, like I said, legitimate reasons for doing these things. I'm not trying to say that these are all bad ideas, but it is hard to circumvent the idea that if you put tariffs on, that's not a positive for the economy, at least not in the first and second round effects.
Guys, how old is Trump?
78, right? Or 79?
First announcement, baseline tariff rate of 10% for all countries. That's the first announcement that Bloomberg put up. Second thing I want to say is just before we started the show.
That's lower than the 20% that we were expecting. Is that right?
Yep.
Okay.
And the way I see it right now,
stock market just shot higher by about 25 handles in the S&P. So there's your answer.
Moving higher. Yields are moving a little bit lower.
Very likely of Trump, right, to scare the market and kind of under deliver on the.
Right? I wrote a whole thing on that today. It's you literally, if you've been watching him since the 70s, which most of us have, it's what he does every time. It's called anchoring the negotiation. You dumbasses who have to react to everything he does. Of course, he pulls a rabbit out of his hat. That's his narcissistic way. Anyway, sorry.
No, it's okay. That's the only one that's been announced so far that I can see. Guys, in the comments, if you see anything I haven't announced, throw them in there, please. Wilbur Ross, Trump's Commerce Secretary in the first term, as well as being lots of other things, right? In his long career. He's 87 years old. Trump's like, what, 80? 79?
79, yeah.
Wilbur Ross, by the way, in his interview seems to have aged a lot more than Trump, but I think it's exponential when you go from like 82 to 87 as opposed to like 72 to 77. But anyway, he basically laid it out like this. He said, I think that Bloomberg had him on because Bloomberg has a bent now, which they didn't have 10, 15 years ago. And they had him on, and I think they had him on because their relationship was very strained in the end, right? But Wilbur Ross said that this is not something other countries can survive. He said, our economy is so much bigger and we buy so much more. And this is how he put it. He said a $10 effect to the Canadian economy is a $1 effect to the US economy. Eric, do you think that's, first of all, accurate? And number two, do you think that's how the other countries will see it if they try and hold out? Obviously, Carney, specifically from Canada, said, our traditional relationship is over. And then you combine to that they may need to build up armies if they're actually going to kind of quote unquote stick it to us. So what's your thoughts on that?
Yeah, I don't know if the $1 to $10 is precise, but the point I think is well taken that in an economic battle, it's unlikely that we would lose if it's taken to its extreme. But I don't think that should be misinterpreted for the fact that if countries do want to try and go a couple rounds with us, that won't also be painful for us. We'll win in the final analysis. We do have, stronger economy. We do purchase more from them, and we can certainly inflict more pain on other countries than they can us. But the adjustment process is not, wouldn't be painless for us either, particularly if the country we're going against is China. They have a pretty strong hand against us as well, although I do still think that we would win that battle. That would be a painful process. And I think the one thing that we don't know is what the pain tolerance in this country is. It doesn't seem to be that high, at least in the last several decades, as far as asset markets are concerned. So, if we do go down a battle where we're, tariffing other countries and it escalates and it leads to disruptions, we have elections just like other countries. And it's in my opinion, the message as to why we're doing this hasn't been super clearly articulated to the broad public. says we've been ripped off, and if you go by the numbers and trade deficits, you can make a case for that. But I don't think the everyday American is super clear as to how this has negatively impacted them, particularly if they haven't worked in one of the industries that's been exported to other countries. A lot of people have actually been beneficiaries of the cheaper goods and things like that. So, we certainly would win the economic battle against other countries, but it's not like it would be a painless process for us. And as we get closer to the midterms and stuff, I think maybe the politicians' pain tolerance will go down as well. So perhaps why he's trying to do this up front and more quickly.
Yeah, it's funny you say that because Wilbur sounds like I'm talking about a horse. You ever say a word and then it becomes a sound? There's a name for that. Wilbur.
Insanity. Move along.
Yeah. So Wilbur said, he goes, obviously it'll hurt us too. We'll go into a recession, but they'll go into a depression. So that's the way he put it. And he said that they can't do that. And he suspects many countries will react the way Israel did.
Fair enough, but try selling a recession to the American.
Yeah, agreed. And that's
not so easy either. Right?
That's why I said this is a 2-year term, not a 4-year term, because
right.
cover things quickly. Then which, you look at the stock market. If I put up a NASDAQ chart, it looks like it's basing to me now. I mean, I've been a proponent, Jimmy knows this, of a 15 to 30% drop this year in stocks, and we hit over 15 in the NASDAQ, in the S&P too, Jimmy.
No, not in the S&P, but in the Russell for sure.
No, the Russell and in the NASDAQ, so I'm claiming victory on that. But
why not?
Yeah, because it's our show. But when you look at it from that perspective, it does look like it's basing right now. And again, all I've seen announced so far, guys in the comments, let me know if there's more, is this 10% across the board for every country. That's it. And Jimmy, where do you got? I got stock futures rallying like
mad. Yeah. So it seems
less up on the NASDAQ future right now.
Less punitive, less like we all know we lost a little bit of the bid. So we're up 42. This is the daily, but we were up 20 handles more than that just a second ago. So I think it's just kind of flying around, but still interpreting it as largely positive. Can I ask a question about markets real quick?
Holding up a big board. I love him so much. Go ahead.
I love him.
People have called us MAGA, Eric, Jim and me, and we're not. We like a lot of policies, and he's funny. I'm sorry. All right, go ahead, Jimmy.
No, and just to put in perspective what Bobby just said too, we argue against Donald Trump all the time. We did not believe the fiscal and monetary policies of the last 4 years were sustainable, and I believe we both voted the same way. I voted for Trump. I'm not proud of it. I'm not wearing a red hat. I think a lot of the shit he does is absurd. But I do think we were sailing a little too close to the rocks when we were racking up $1 trillion of additional debt every 95 days, which brings me to the next question about the 10-year. So 10-year yields dropped from 5% to today they hit 4.1. They did not, which by the way was our big technical level. I thought if it settled below 4.1 and then any additional weakness in yields, strength in bonds would have brought us down to 3.8. That did not happen. And now stocks are rallying. But let's talk about the decline in 10-year yields. What was that telling us? Was that just a rotation out of stocks or a perceived rotation out of stocks? Was it recessionary? What are your thoughts?
So the economy has been going through a slowdown phase. It's been a difficult period because generally speaking, let's take the
pre-COVID. Go ahead. 25% on autos. All right, go ahead.
25% on autos. Okay. Did the market not like that one?
That's what probably, Jesus, the market just dropped 70 handles in the S&P from up 40 to down 25.
NASDAQ
maybe worse than that's surprising that he's
NASDAQ futures were up 2%. Now they're only up 1.7.
And the S&Ps are down significantly. Yeah.
Holy shit. Sorry. I'm sorry. Keep your
that's good because I might have used that in my answer.
Right. Yes.
34% on China.
Oh,
30? How did we get to 30? How did we get that number?
It's because it's Walter Payton's number.
Is that okay?
That's Walter Payton's number. That's what it is.
Okay. So in the pre-COVID period, we had growth that averaged about 2%, let's say, give or take. And we would go through these cycles in growth, and growth would oscillate from 3% to 1% to 3% to 1%, and it would average at 2%. So every time that you would decelerate, you'd quickly have a recessionary fear, because if you're slowing from 2 and you're going to 1, that's pretty dangerous, and rates would drop and all the rest. The problem is after COVID, we pushed growth to these really, really high levels of like 6, 7, 8%. So we've been in a slowdown for a long time where the growth rate has been coming down, but it's like a plane descending from like 100,000 feet rather than 20,000 feet, where the economy has been technically slowing as far as the growth rate has been concerned, but we're slowing from a high level that it's been slowing for a long duration without biting to those more recessionary levels. So what happened was the economy was pushed up. The Fed had to go on this tightening cycle. Then growth started to come down. And then we started to hit, more normal levels of growth in the 3% range. And then growth continued to come down. Then the employment market started to slow down, and the Fed pivoted from monetary tightening to easing. And we're still in this growth slowdown phase. The only caveat is that the slowdown hasn't fully engulfed employment, in the sense that we don't have job losses, even in the narrow cyclical sectors that always precede broader economic or broader job losses. So what I mean by that is, if you go back to all the business cycles across history, job losses always occur first in residential construction and manufacturing. Generally, both of them simultaneously, but it could be one or the other. You can't find a business cycle where the job losses didn't start in residential or manufacturing.
Residential construction, is that what you're saying?
Correct.
That's fascinating. I did not know that. Thank you for that. But anyway, go on.
Correct. So as we've gone through this cycle, now the economy had, it went through this boom. We had huge jobs in residential and manufacturing. Then the cycle pivoted. Growth has been slowing for a long time. Now, over the past 9 months or so, we have just started to get job losses in manufacturing. But the job losses have been extremely small. We're talking about, from peak to trough, about 50,000 job losses in manufacturing, where in a recessionary period, you're looking at like 1 or 2 million. So job losses are accumulating in manufacturing, but extremely small. Job losses have not started at all in residential. So if you take the two of them and you put them together, we're pretty much flat on both of them. So that's why the 10-year isn't going up anymore. And there's sort of a ceiling on rates because those sectors aren't adding jobs. And net, if you squint, maybe they're losing a fraction. But the 10-year won't flush and really start going down because in order to do that, the market needs to have expectations that the Fed's going to cut 200-300 basis points. They're only going to do that in a recessionary environment. And we can't evolve to the next step, or that recessionary phase of the business cycle, until you start to get job losses in those sectors. Once you get job losses in residential and manufacturing, then you generally still have a couple of quarters, sometimes even longer. In the case of the 2007 recession, it was actually 18 months where you had job losses in resi and manufacturing before it spread to economy-wide job losses. So if we have not started having job losses in those sectors yet, the economy is unlikely to go into recession in the next 3 to 6 months, let's say. So the propensity for the 10-year to have a big flush is not really there. But since those sectors have transitioned from job losses to now maybe the smallest of job losses, there's kind of a ceiling on rates too. So the more outsized decline that we've had in rates over the past couple of weeks is probably more associated with some of the risk-off market sentiment as opposed to recessionary conditions. We'll get the job report on Friday, and we'll be able to update that. But that's sort of my overall view on what's going on in the rates.
What about the thesis that Scott Bessent, Donald Trump are in some ways kind of negotiating a slowdown and a stock market correction in order to lower yields to term out some of the debt that the previous Treasury never did? They did not want to term out the debt at 5%. They probably would like to term it out a lot more at 3.5%. Any validity, or is that tinfoil hat shit?
Before you answer that, we got more rapid fire tariffs here.
Let's hear that first.
It's 20% on the EU. All this courtesy of Widge. 24% on Japan. 32% on Taiwan, which remind me to tell you a funny thing about Taiwan. 10% on the UK. 31% on Switzerland. Not sure why he's so mad at Switzerland. And 10% on Brazil. And we already know about the minimum basic tariff of 10%. That was the first thing that we talked about. So go on. That's all we have so far.
So these numbers are interesting. 31.
Yeah, they're all so random, doesn't it?
Yeah, I don't know exactly how we're getting there. I'm sure he's giving a good explanation.
I have an image of him being.
You're sure he's giving a good explanation?
Yeah, I have an image of him being in the Oval Office after this particular conference going, well, 31, that was a great ball player on the Yankees.
Yeah, right, exactly. No, Jim, I don't think that they're trying to engineer the slowdown. I mean, I've never seen anyone thread the needle like that. It also sort of ascribes them this power and control over the markets that I don't think is really there. It would give the impression that they can create a recession and then whatever they want, just turn it around and go the other way. And if that was the case, we'd never have a recession ever, right? Yes. Government would be able to kind of have been able to stop.
I agree 100%. I thought it was an interesting thesis, but I agree.
I hear it all the time. Believe me, I hear it all the time. I think it's a stretch. I think it's really a stretch.
Time out quick. It is 30 minutes into the show, which means we have to talk about the offer from Tradier. Luis, can you please put the banner up? Tradier is offering 3 months free of Tradier Pro. This is an outstanding system if you are an options trader, whether you are a beginner all the way up to an expert. We've had people on our show who have been trading options for decades, and when we mention Tradier Pro, they're like, oh, crap, yeah, that's the system I use. I can't live without it. Give it a try. It is free for 3 months. There is no obligation. Just scan the code, sign up for Tradier Pro. It'd be a favor to us. We appreciate it. Sorry about that. You had to be part of that, Eric. Anyway.
No, that's all good. I just got a chance to catch up on my feed. Is the S&P down 4%? Is that accurate?
Well, no, I don't think it's down 4%. Jesus, let's take a look.
Am I got a bad?
I think you got a bad feed. I have it down 1% on the whole day, which means it wiped out a 1% gain as well.
Yeah. Got it. Okay. So maybe 2% from the highs or something.
That's what I mean.
Yeah. Okay. That makes more sense. I was gonna say that would have been. Yeah, I do see. Maybe it's
I bet you're looking at like aftermarket where we're looking at futures. So futures calculated in today's gain because they're still open.
I see. Okay.
SPY or whatever you were looking at.
Got it. No, I'm just looking at the Twitter feed and somebody wrote that, but that's as good as Twitter's worth. So it might be totally wrong.
Yeah. So I want to take this. I want to take this one step further. And again, I think that the answer, I'm going to say the obvious answer. This is a stretch. Okay. But I watched a video from a guy, Jimmy, what's that really conservative college? Hillsdale? He's a professor at Hillsdale. And he said that if Trump achieves the 4 or 5 things that he's trying to achieve, he'll be the most significant president in modern history. Now, still be the funniest, but he said that no one's talking about the border anymore because border crossings are effectively zero. They're obviously not zero, right? But they're effectively zero. No one's talking about egg prices anymore because they've gone down. I do not give the administration credit for that, right? I don't give the administration credit for the earlier drop in crude oil either. And it's starting to climb up now. Gas prices are starting to slowly climb as they normally do before the summer driving season. But this seems a little more than normal to me. Side note to that, OPEC meeting tomorrow, which could change that very quickly. The way that it was laid out, this is not my opinion. This was the person whose videos I watch, whose name escapes me right now. He's going to tariff everybody. The tariffs are going to settle out at some level. Some countries are going to pull back their tariffs on us, and then we'll pull back ours on theirs. Other countries will leave them in place. That will result on money going to the Treasury as it did in 2017, right? And most, again, his view, not mine. And most of the companies will eat a good deal of the tariff increase, at least for now, because they don't want to lose market share in the US. And then he's going to break down the entire tax structure, right? Attack the IRS, cut their funding, cut their employees, and then do regulation cuts and tax cuts for basically everyone across the board. And this will be a substantial and easy way without the Fed to let the stock market recover because there'll be corporate tax cuts in there as well. What's your stance on that? Because my stance on that's a lot of stuff to get done in now less than 2 years.
Right.
I agree with you. It's also a lot of, I feel like it's like hitting black on the roulette table 6 times in a row, right? Like you have to get, he's got to get the tariff thing done, and then he's going to do the trade thing, and then and it's like it makes it sound like he's going to go
regulations, taxes,
and he's going to nail all of them without a hitch. It's It's tough to comment on whether that's going to happen or not. I mean, I think that it's a stretch, just given the fact that things in American politics don't seem to get done very quickly in general.
Right.
We'll see. And he's got, what is it, 12 or 13 months before they got to start campaigning. I would also say that we haven't actually gotten any laws passed yet.
Sure.
So we're going to actually have to see what happens when they actually try and pass a legislation. How many people are really on his side? The majority is not as substantial as
no, it's slim, right?
I mean, he loves to say that there was a big mandate, and it certainly was a pretty decisive victory. But I don't think that the majority that he has is is consistent with how strong of a mandate he's saying that he had. I mean, we're talking about a couple seats here where he's going to have to probably give concessions to some of these people. I don't think it's like a situation where he can pass anything and everything. So I think it remains to be seen how effective he is at jamming some of these things through. I remember even just a couple of weeks ago, we had this talk of, are we going to do this as two bills, one big, beautiful bill? I think we're down.
You started doing Trump. You started doing a voice.
Yeah, right. I can't help myself. I think we're in the one big, beautiful bill phase now. I think that's kind of where the consensus has landed us. But we don't know if there's going to be no tax on tips. We don't know if there's going to be just an extension of the previous one. So that whole sequence of events, I'll take the under on, just because I feel like it's a safe bet. Not saying anything about Trump's ability to negotiate. It just it seems tough to me.
I mean, it's like where the probabilities are, right?
Yeah.
So like if I were taking the other side of that, I'd be buying a way out of the money call.
Yeah, right. And it would speak to the fact that if he was able to get all of those things done, whether you like them or not, it would be a pretty historic run in terms of successive accomplishments, if that's the way that you view them.
So here's, okay, first of all, you suggested that Trump exaggerates and speak hyperbolically. First of all, I'd say to you, how dare you? How dare you insult our president like that? Two, we're talking about what sounds like tumult in the economy for the next potentially year and a half. So are you saying that risk assets is not a place that you'd want to be, particularly equity markets, in this current environment?
So whenever the economy is slowing, as it has been, that generally poses risks to asset markets. Now, as I mentioned, the economy has been slowing down, but it hasn't been super close to recession, which is why you've had sort of a bifurcation in asset markets where the Russell 2000, for example, which is much more sensitive to the real economy and, the Main Street, has been pretty crappy for like 4 years, right? Perfectly indicative of what we're seeing in the underlying economy. But then you have the more monopoly companies that continue to extract growth from the economy. Those stocks only really go down sustainably when the economy is in a recession or about to be in a recession. So with the economy slowing down, I would certainly always avoid anything that's economically sensitive. And my poster child for that is Russell 2000, micro caps, things like that. I'm very cautious about being overtly negative on S&P 500 or NASDAQ because of the monopoly constituents that have such a sustainable bid from retirement passive flows as well as buybacks, that those stocks tend to hold on and do really well until there's recessionary condition. We have a difficult dynamic now, as we're seeing, where the economy is slowing, so that posed risks. And then we threw on this external shock of tariffs, which has caused things like the S&P and the NASDAQ to go down, and the Russell, of course. My view was that if he removed all the tariffs and we went back to square one, that S&P and NASDAQ probably would have rallied close back to all-time highs because we weren't that close to recession. But with these announcements that are rolling in, it looks like we're actually, perhaps to my surprise, escalating this more than we were yesterday, which puts us back in the environment of growth is slowing and we have external shocks. So I'm certainly cautious on risk assets, but I'm always pretty reserved in being outright negative on S&P or QQQ, just because I think that the the secular trend is a tough one to fight. I think there are lower hanging fruits if you want to play the short side, and I kind of like the Russell on that one.
So two things: 20% on South Africa is another one, and Elon Musk and Caroline Leavitt have both publicly, basically, Caroline Leavitt called it garbage. Elon Musk and President Trump have both publicly stated that Elon will depart from the public service as a special government employee when his incredible work at Doge is complete. The scoop is that Trump was leaving early and he was going to return to Tesla. And both Leavitt and that's supposedly why Tesla bounced this morning after coming in like short 13,000 sales of cars from the last time they announced. Basically, Elon and Caroline Leavitt has said that scoop is garbage. He's not going anywhere until he's done with his job. So that's one thing. So I'm not sure if I was able to get from what you said, Eric, as to whether you like the Russell here considering the tariffs, because you said risk assets. And with tariffs in place, I look at the Russell as a high beta treasury almost. So is that crazy to say? Like, I really like the Russell here. It's gone down the least on these announcements. It's led the last couple of days, both higher and lower, but I think it could head higher now. What caution would you give me on that?
My caution is that it's generally the most economically sensitive. So as the economy is slowing, over the last 18 months, it's dramatically underperformed. Should these tariffs further damage the economy and engulf employment into it, like let's say these tariffs cause further slowing in the manufacturing sector, further job losses in the manufacturing sector, that's going to put more pressure on the economically sensitive assets like the Russell. That being said, when you have market pukes, so to speak, sometimes they can decline a little bit less just from like the systemic selling aspect. But when you look at the total decline, it almost like if you look at the chart of like IWM to S&P, the relative performance, I mean, it's literally just straight down for years and years. That I don't think will end. And if you want to try and catch the little blips where the Russell outperforms, that's a hard game to play. And generally, those blips are associated with accelerating economic periods, of which I don't think we're going to be in. So if you were going to look at that chart, IWM to SPY or IWM to QQQ, that just persistent downward trend, I think you keep playing that. The only time you're going to get the big sustainable bounces, I mean, the ones that are like more than a week or two, generally come like when you're coming out of COVID. That chart had a huge, 9 or 10 month rip. Another one in 2016 to 2018, you had another big one. All of those are, economic accelerations. Since I don't think that we're on the cusp of that, I don't like Russell over the broader, safer indexes. That's not to say that, like, if we have this announcement today and the market's down 5% tomorrow, Qs will probably be down more than SPY, just from the puke aspect of it. Yeah. But when you look at that chart over any sort of time horizon, I would think that the IWM keeps underperforming Qs just because the companies are they're economically sensitive and they're so weak relative to what are, if we're just being honest, monopolies.
Mm-hmm. So you keep mentioning economic damage, and this is just a quick follow-up. Then I want to let's put up another Widge comment because it might have something to do with my follow-up here. Widge says, I'd want to be a small company in the US with underutilized productive capacity. We're seeing things happen around here. He lives in a manufacturing area. We don't know where, and we're not asking. And my follow-up is you keep talking about economic damage, and I'm wondering if you think the economic damage is not purely stock related, but is based on margin compression from the tariff and possibly them absorbing it. Do you think it's going to be wider? And lastly, does yesterday's ISM bother you, where we fell back into contraction territory on manufacturing, but prices paid shot up to 69? So it's kind of a two-part follow-up.
Yeah. So when I say economic damage, I mean that the existing slowing of the economy that was in place prior to the tariff announcements. And by that, I mean the significant slowdown in some residential apartment construction, as well as the existing job losses in manufacturing that have started to accumulate. So before all this tariff stuff happened, economy was slowing down, and there were pockets of real weakness in the sectors that generally lead, in the sectors that are generally sensitive to monetary policy. Like I said, it wasn't cusp of recession or anything like that, but there was economic weakness in cyclically important sectors prior to the tariff announcements. And then we have the economic theory that we mentioned at the beginning of the call, where tariffs on face value are a negative overall to economic growth. So when you take those things together, that's what I'm talking about in terms of the damage. And I think you're right that companies can take it in the form of margin compression. And my fear there is that if margins compress too much, their only step really is to lay people off in order to protect those margins, which would have the propensity to further us down that road of more manufacturing layoffs and potentially residential layoff, which have not happened yet, to be clear. That would be an important signal. So that's what I'm referring to in terms of economic damage. In terms of the ISM, I wouldn't say I'm any more concerned about the ISM than I was, in months past, because we've been pretty much contracting for almost 2 years in the manufacturing sector. The contraction, as I mentioned, has been super mild. When we came out of contraction, there was a little bit of hope that we were having a revival. None of my data suggested that we were having a revival. I work with many manufacturing companies, both domestically and in places like Mexico. There was really no sustainable manufacturing upturn. It's been a brutal environment for most manufacturers because they've been contracting for literally 2 years, but the contraction's been small. So it's like death by 1,000 cuts. It's been a very difficult environment for operators. Everyone is trying to shutter capacity, and you don't want to shutter too much. And then we had some of this tariff pull forward here. So it's been a really tough environment for manufacturers. I'm not any more concerned than I was prior to that report. I think that manufacturing is at risk here from the slowdown that was already in place, plus these tariffs that will maybe in the long run bring some things back. I'm a little bit skeptical about that, but in the short run are going to be pretty disruptive.
So Bobby and I, for the last 3 years, have been accused over and over again of being some crazy gold bugs. I gave a speech 3 years ago about
streaming right now, by the way.
Well, that's what I was going to say. Gold has, I didn't even check it, but if these are going to be viewed as adversarial around the world, that is going to kickstart the move in gold again and break it out of that little pattern. Are you investing in gold? Are you telling people to hedge with gold, with Bitcoin, with anything? What are your views there?
Yeah. So I traditionally think that having a small slice of gold makes sense for most people. I don't get really any more tactically than that. It's not my area of expertise. I was long of the opinion that gold was traded inversely to real rates. That correlation broke pretty aggressively over the last couple of years, and I can't pin my finger as to what is driving gold. I hear all the theories out there. It's not my wheelhouse at all. So I would one back to you, but I
know why.
Yeah. So
yeah, well, I mean, when we had Luke on the show and he laid out something that I thought was beautiful, and it's kind of like a mini divesting of foreign entities holding their reserves in just dollars and treasuries. And I'm not a de-dollarization guy. The reserves held in dollars has gone from 60% to 57% in 3 years. Is it significant? Probably not. Is it worth noting? Sure. If that money's going somewhere else, it's probably going to gold. What happened today probably doesn't slow that down at all. If we are pissing people off around the globe, the notion that they're trying to come up with a better way to hold their reserves than just US dollars and treasuries is pretty reasonable to me. Bobby?
Yeah, gold, I think. So if you take it to before any of this was happening, right? This last move is what Luke said it was on our other show.
Yeah.
It's sort of a change in the flow of funds across the globe, right? That's number one. But number two, gold is actually a three-headed monster, not a two-headed monster. So the typical inverse relationship between the dollar and rates and gold, it takes on a different sort of path, similar to what you just described, when the market thinks there's coming inflation and the Fed's not fighting it. So when gold continued to rally after the Fed stopped hiking rates, the only pause in this rally is when the Fed hiked rates. And even then, it was a sideways correction. It wasn't a push lower. And that's because the market was thinking you need to keep going. And then the Fed said, I think we're good. I think it's going to come down, even though inflation is still 3.1%. And even though inflation is still 2.8%, if you look at PCE, we're going to start talking about easing. And gold basically said, you're a fucking idiot, because inflation is still in the pipeline. And now we're seeing it. We're seeing a little bit of strength in the last, both sets of figures outperformed CPI and PCE. And the Fed still, the CME Fed Watch Tool still has 5 rate cuts priced in through 2026. Then you add to that this new presidency and these new, this new sort of long-term plan that likely is going to shift the flow of funds and send foreign money into gold, not into U.S. Treasuries. That's only the thing. If you want, we'll send you what Luke said. But I want to put up, that's my theory on it anyway, and that's why I
can't argue with that.
Either way, it's my biggest long, has been for about a year, and we're sitting pretty. Which, by the way, I don't, for a broader perspective, I don't like seeing gold going parabolic, because that suggests to me that something's very, very wrong. But you know, it's nice to be right. You know, what are you going to put up? I want to
put up Tim's comment about residential construction, just because it's pertinent to what you were just saying. Residential construction layoffs are just starting in the Florida and Texas markets. Tim is a lender for for more commercial real estate and some huge multifamily projects. So he would be aware of it happening. And then he also put a question in here. But first, I want to talk about the summit that Tradier is having, Jim.
Perfect. You want to talk about it, or on me too?
No, you go ahead and talk
I'm excited. Luis, can you put up the banner about the summit? It is going to be on April 9th, the Future of Trading, the Tradier Options Summit. Please join us. These things, not only are they fun, they're fun to meet people, they're fun to compete. It's there's not a trading summit. I was thinking of something else, but it's fun to meet people. It's fun to hear their opinions on things. Give it a go. It's April 9th. This is next week, the Tradier Summit. Please join us.
And then Tim asked one more question of you, Eric. Any thoughts on TLT and long-term rates? Bought some TLT in the money calls at 335 so far, so good. I thought rates were going a lot higher. Jim and Steph Pomboy disagreed with me, and they've been right so far. So what's your thoughts on it?
So on his first comment on the layoff, it makes sense on his anecdote, because Texas and Florida are for sure the weakest markets currently in residential construction. Those also typically tend to be the most boom bust markets. So layoffs starting there would make sense. I take the anecdote and I believe the anecdote. I got to wait to see it come through the data. Of course, places like the Northeast have such small amount of construction that, you know, those markets aren't that big boom bust. The big booms and busts are generally like Texas, Florida, Phoenix, Vegas, places like that. So the comment makes sense. The timing makes sense. We'll see how long it takes to come through the data. As far as TLT, I had mentioned my comments on rates in that I think that there's a ceiling on rates. So if we just think, I'll talk in terms of TLT. I think there's a floor on TLT because the Fed's not going to be raising rates. I don't think that we're on the cusp of a big burst in inflation. And I don't think that we're on the cusp of a acceleration in growth. All of those things together would give you a floor on TLT. I'm a little bit cautious about pressing rallies in TLT until I see more job losses accumulate in manufacturing and residential, because that would tell me a recession is much more proximate. The Fed's going to have to cut aggressively. And that's when you'll see TLT, 100, 110, 115 on those rate cuts. Right now, you could get the rallies in TLT on the risk-off events like we're seeing now. So tomorrow I'm sure will be a good day if the market is getting clobbered. But that's a tough one for me to play as a business cycle analyst, because I'm trying to guess tariffs and policy announcements and things like that, which is not my wheelhouse. So purely on a macro business cycle standpoint, I like, the fact that I think TLT has a floor. I'd be comfortable buying the pullbacks, and this range that we've had in bonds has been good in that sense, where when TLT pulls back, you can buy it with some comfort that there should be a ceiling. And then as TLT gets extended on a risk-off event, unless we see more proximate recessionary concerns, you always have the risk of getting beat back down if we pull the tariffs off or the market snaps back or things like that. But I do ultimately believe that we will not escape a recession in this cycle. I do believe we're going to continue going down that path. The job losses in resi and manufacturing have taken longer than I would have expected to show up, but I don't want to break the process that I have of that. That is critical signpost to look for on the way towards a recession that we just haven't got to yet. Once that happens, the process becomes more self-reinforcing, and the Fed will start to price in the 200 basis points plus of cuts that will ultimately probably come. I'm not of the opinion that we're in a higher terminal rate environment. I think that at the end of this story, we'll have rates that are closer to pre-pandemic than in the 4 to 5% range for a long time.
Wow. So I was doing all kinds of hand signals, and we forgot to tell you before the show, those are between me and Jim. You should always continue to talk, which thankfully you've done. But he just said that USMCA exemptions will still persist. And he also said Canada and Mexico are not subject to reciprocal tariffs for now. So again, he's leaving us in a little bit of limbo about what's going on with our biggest trade partners.
So help me out. Was that a good reaction or a bad reaction?
Well, no, like what does that mean for autos? I guess that means that autos so I have a friend that works for a subsidiary of Ford, and he's been super nervous about these reciprocal tariffs with Canada and Mexico and the auto tariffs in general. And he explained it to me. I did not know this before. I knew parts came from other countries, but he said literally a part of an engine will go down to Mexico. Another part will be inserted, and then it'll go up to Canada, where some polishing and inserting and more parts will be done. Then we'll come to the US for more parts, go back to Mexico. He said before you get a completed engine, it goes across both borders maybe 2, 3, 4 times, which in theory, each time
it would get tariffed. Right.
Right. And he was freaking out. He's like, I don't know if we're going to even be a company in 3 months.
Right.
It's great. So obviously the USMCA and the Canada.
But I think that's why there's a huge skepticism, myself included, that these tariffs are going to go in the way that they're being laid out, because that's obviously insane if it gets tariffed 6 times going across.
Right.
Like it's just impossible that would be the case. So what's gonna be the carve out? What's gonna happen there? And I just think there's so much skepticism because we all know. I mean, Trump's not gonna blow up the economy on purpose. So there was a beauty of free trade between the U.S., Mexico, and Canada, where parts would flow very freely, and it was efficient means of production in doing that. It just doesn't seem plausible that if it goes across 4 times, it's going to get tariffed 25% 4 times. It just seems impossible that that's going to be the case.
No doubt about it. Bob,
can I just throw this last rant in? And this is why I said earlier on, Bloomberg now has a bent. So they have a headline. It says, summarized by Bloomberg AI. Donald Trump has offered varying justifications for tariffs, claiming that trading partners are ripping off Americans and that factories need to come home. However, for decades, American companies benefited from making products abroad, which brought benefits to the domestic economy, helped control inflation, and delivered influence for Washington. That second part, that however, right, is exactly like, I guarantee you, I didn't watch the speech, but I guarantee you somewhere in there, he said corporations have been hurting middle-class American workers. And this AI said, however, American companies have benefited, which is likely factual.
Sure.
But has a bent to it. The approach of manufacturing in far-flung destinations was a deliberate strategy that brought opportunities and advantages to both the U.S. and its trading partners. Dismantling this model could lead to many losers. That was
the point of it. That was the point of it. The point of it was supposed to help the workers and disadvantage some of the companies. So, I mean, he said he's been very, very
clear. That was his point of doing this. So putting this
right or wrong. I mean,
is there any way, guys, I could share my screen? Is that a possibility here?
You can. You share it.
I got a chart that perfectly shows what's going on. So what we're looking at here is corporate profits as a share of national income on the left and compensation of employees as a share of national income on the right. Just to make sure you guys can see that, right?
Yeah, perfectly.
So, we have national income, which, is basically synonymous with GDP or GDI. And then there are a few layers that roll up to national income. So you have corporate profits, you have wages, You have like 6 line items that make up national income. From 1990, and you can think of the left-hand side, corporate profits, sort of as profit margins, right? It's not exactly the same, but it's close enough where you can use it interchangeably. From 1990, average American corporation was running about 8% profit margins, and it has just exploded to 16% profit margins now. The generally compensation of employees is where that's come out of. And that speaks to a variety of effects. You can't pin that on one thing. Offshoring labor certainly is a contributing factor, but it explains, the persistence of or the strength of asset markets, particularly the multinationals. And it's been a really, really, really interesting environment where if you look at 2007, we got to about 14%. We had a huge crash. Then we snapped back and we almost never went below the peak of the previous cycle from 2010 to 2020. Then we had the pandemic and we snapped to another all-time high in margins. I mean, it's sort of antithetical to capitalism to have profit margins that are this high and sustained. I mean, for the 60 or 70 years that preceded 2008, profit margins were a very mean reverting chart, which is very capitalistic. If margins get too high, people come in and compete those margins away. We've slowly been shifting to this newer type of economy, which is detrimental to employees, where companies have more monopoly characteristics and they're able to really maintain profit margins that are probably too high. It's not corporate greed or anything like that in my sense. There's a variety of factors that go into it, but
Eric, is one of the factors that goes into it rates held inorganically low for so long, encouraging top heavy industry, a lot of conglomerates, a lot of taking over. That's part of it, right?
No doubt, because if you have lower interest expense, that's just going to flow to the bottom line. So absolutely no doubt that that's the case. And that disproportionately benefits Apple, that issues 1,000-year bonds at 75 basis points compared to, like I was beating up on, Russell 2000 companies that probably have more rolling short-term financing. So yeah, absolutely, that's a factor. Another factor that plays into this is we've have had lower effective corporate tax rates over the last 30 years. The marginal rate that we quote in the news changes, up or down. It's mostly trended slightly down, but the effective tax rate for corporations is like 11 or 12% right now. That's down from like 30 in the 1990s. And we could probably roll up like 6 or 7 reasons as to why profit margins have had that secular rise on the corporate side. Some of that certainly is this trade that we're talking about. And, so to the extent that he undoes that, I think, Bobby, you were mentioning that one of the avenues here is that corporations will take lower margins as a result of it. They certainly can handle it. They're up at 16%. That doesn't mean that the share price will like it, because the share price being as high as it is, and everyone talking about how the market's been, quote unquote, overvalued for decades. Like, it sort of is based on traditional measures, but what PE should you place on a company with 18% margins versus 8% margins, right? It probably does warrant a higher multiple, especially if you think that margins are durable and sustainable. So yeah, if he undoes some of this trade and that's negative for profit margins, that could in turn be a change that is needed, because this looks like it's gone somewhat out of control. But that probably would result in pain in the area that's been a huge beneficiary of it, which has been share prices, right?
No doubt. Bob, we got to wrap. We're going to have to start paying the producers overtime if we keep going.
Yeah, I got to put this last Widge comment up, because first of all, he complimented your chart. We had that up while you were talking. I don't know if you saw it, but is a last comment that we're going to do up here today, which says China entered the WTO in 2000. Companies went all in on exporting jobs after 9/11 recession. We're going to have a lot to talk and write about in our newsletter this weekend, Jimmy.
By the way, so I'm glad Bobby mentioned that too. Join our newsletter too, because we're going to take down some of the topics we talk about on Tradiers or the Trader's Edge, break them into actually actionable trades that we're making. Never does someone as smart as Eric come on who doesn't alter the way we think about our positioning, and we will be doing that. And please sign up for our newsletter on Slice, and we'll talk about Tradier show, and we'll talk about that. Eric, do you have any final words, or can I play us out?
You could play us out. This was a ton of fun. I really appreciate it.
People where to get a hold of
having you. Follow Eric on Twitter. He's a great follow. He posts smart things, unlike us who just shit post. That's kind of what I do. It's kind of my thing. Thank you guys for watching the show, for all the DMs, all the retweets. Remember, Bobby and I were in legacy media for 25 years. The reason we had to come out of it is that you are always at the whim of some overzealous producer or a sponsor telling you what you can and can't say. Our opinions may be bullshit and wrong, but we want to at least be able to express our own honest opinions. And that's why we're trying to create formats that do. Thank you guys so much. This has been Tradiers, the Trader's Edge. Please sign up to the newsletter. We'll recap some of this episode and talk about how we're trading it. Thank you guys.
See ya.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.